what happens when a company lends money, buys an investment, or raises finance through debt? The accounting can be very different, depending on what the financial instrument actually is, how it is managed, and what its contractual cash flows look like. In this chapter, we're going to break down IFRS 9, Financial Instruments, Classification, Measurement, Impairment, Derecognition, and Hedge Accounting. And by the end, you'll have a clear ACCA Financial Reporting exam map for tackling IFRS 9 questions. Let's begin. Imagine a company lends $10 million to another business, or buys shares, or issues loan notes to raise finance. At first glance, these may look like very different transactions, but accounting has one big question to answer. What exactly is this financial instrument? And how should it be measured? That's where IFRS 9 comes in. IFRS 9 sets out the requirements for recognizing and measuring financial assets, financial liabilities, and certain contracts involving non-financial items. It replaced IAS 39 and became effective from January 2018. For ACCA Financial Reporting, IFRS 9 is particularly important because questions can test classification, measurement, impairment, derecognition, and hedge accounting. The standard is ultimately trying to give users useful information about the amount, timing, and uncertainty of future cash flows. So throughout this chapter, remember one simple idea. First, understand the instrument. Then, determine the accounting. When we classify a financial asset under IFRS 9, there are two major tests. The first is the business model test. This asks, how does the company actually manage this group of financial assets? There are three broad possibilities. First, hold to collect. The objective is primarily to collect the contractual cash flows. Second, hold to collect and sell. The company manages the assets with both collecting cash flows and selling assets as objectives. And third, other business models. For example, assets managed on a fair value basis or held for trading. But the business model is only half of the decision. We also have the second test, SPPI. That stands for Solely Payments of Principal and Interest. The question is whether the contractual cash flows represent solely payments of principal and interest on the principal outstanding. And remember what IFRS 9 means by interest. It includes consideration for the time value of money, credit risk, other basic lending risks and costs, and a profit margin. So don't simply look at the name of the instrument. Look at the contractual cash flows. That is where the classification decision begins. Once you have considered the business model and SPPI requirements, we can determine the measurement category. For debt instruments, there are three main outcomes. First, amortized cost. This applies where the business model is hold to collect and the SPPI test is passed. The instrument is subsequently measured using the effective interest method, with the expected credit loss allowance recognized where applicable. Second, FVOCI, debt. This applies where the business model is hold to collect and sell, and the SPPI test is passed. The asset is carried at fair value. Fair value movements go through other comprehensive income, with the relevant accumulated amount recycled to profit or loss on disposal. And third, FVTPL. This is the fair value category. Changes in fair value are recognized in profit or loss. There is also an important point about equity instruments. Equity investments that are not held for trading may be subject to an irrevocable FVOCI election at initial recognition. And there is also a fair value option for certain debt instruments when doing so eliminates or significantly reduces an accounting mismatch. So the memory structure is business model, SPPI, then measurement category. Now let's move from financial assets to financial liabilities. The starting point is much simpler. Most financial liabilities are subsequently measured at amortized cost using the effective interest method. There is, however, a fair value option. A liability may be measured at FVTPL when the relevant IFRS 9 conditions are satisfied, including situations where this provides more relevant information by eliminating or significantly reducing an accounting mismatch. Now there's an important point about own credit risk. For a financial liability designated at FVTPL, changes in fair value attributable to the entity's own credit risk are generally presented in OCI rather than profit or loss, unless doing so would create or enlarge an accounting mismatch. This is an important difference students should remember. And finally, there are special cases. Financial guarantee contracts and certain loan commitments have specific measurement requirements. Derivatives are generally measured at fair value, with changes recognized in profit or loss unless eligible hedge accounting applies. So for exam questions involving liabilities, start with amortized cost. Then ask whether a specific IFRS 9 rule takes you somewhere else. Equity investments have a particularly important distinction. Under IFRS 9, equity investments are measured at fair value. The default treatment is FVTPL. However, if the equity investment is not held for trading, the entity can make an irrevocable election at initial recognition to present subsequent fair value changes in OCI. This is the equity FVOCI election. And here is the exam point. Equity FVOCI is not the same as debt FVOCI. For an equity instrument under the FVOCI election, the fair value gains and losses accumulated in OCI are not recycled to profit or loss when the investment is disposed of. That is very different from debt FVOCI, where the relevant accumulated OCI amount is recycled on disposal. Students often lose marks by mixing these two treatments. Now, reclassification. Financial assets are reclassified only when the entity changes its business model for managing those assets. This is expected to be very infrequent, and when reclassification occurs, it is applied prospectively from the reclassification date. Financial liabilities are not reclassified after initial recognition. So remember, debt FVOCI, recycling. Equity FVOCI, no recycling. Before we talk about subsequent measurement, we need to understand initial recognition. A financial asset or financial liability is recognized when the entity becomes party to the contractual provisions of the instrument. For regular way purchases and sales, IFRS 9 allows an accounting policy choice between trade date and settlement date accounting, applied consistently. At initial recognition, the starting point is generally fair value. Then we consider transaction costs. For instruments measured at amortized cost or FVOCI, directly attributable transaction costs are generally included in the initial carrying amount. They are not immediately expensed. But for an instrument measured at FVTPL, transaction costs are expensed immediately in profit or loss. This creates a very useful exam rule. Amortized cost or FVOCI transaction costs are included. FVTPL, transaction costs are expensed. Always identify the measurement category before deciding what happens to the transaction costs. Now we come to one of the most important parts of IFRS 9, expected credit losses. IFRS 9 replaced the old incurred loss model with a forward-looking expected credit loss model. The idea is simple. We don't wait until a loss event has happened. We recognize expected credit losses based on information available about credit risk. There are 3 stages. Stage 1. There has been no significant increase in credit risk since initial recognition. The entity recognizes 12-month expected credit losses. Interest revenue is calculated on the gross carrying amount. Stage 2. There has been a significant increase in credit risk, but the asset is not yet credit impaired. Now we recognize lifetime expected credit losses. Interest revenue is still calculated on the gross carrying amount. Stage 3. The financial asset is credit impaired. Lifetime expected credit losses are recognized and interest revenue is calculated on the net carrying amount. There is also a simplified approach for certain trade receivables, contract assets, and lease receivables, where lifetime ECL can be recognized without tracking the normal stage transfers. This is a favorite ACCA exam area. Remember, Stage 1, 12-month ECL. Stage 2, lifetime ECL. Stage 3, lifetime ECL with interest on the net amount. Next is derecognition. In simple terms, when do we stop recognizing a financial asset? A financial asset is derecognized when the contractual rights to its cash flows expire. It can also be derecognized when the asset is transferred and the relevant derecognition requirements are satisfied. For transfers, we analyze the risks and rewards of ownership. If substantially all the risks and rewards are transferred, derecognition normally follows. If substantially all risks and rewards are neither transferred nor retained, we then consider whether control has been transferred. Financial liabilities work differently. A financial liability is derecognized when the obligation is discharged, cancelled, or expires. And there is another important exam point. If the terms of a financial liability are substantially modified, the original liability is treated as extinguished and a new liability is recognized. So don't simply ask, has the contract changed? Ask, has the modification been substantial? Hedge accounting can look complicated, but the basic idea is actually quite intuitive. A company may use a financial instrument to protect itself against a particular risk. IFRS 9 aims to make hedge accounting more closely aligned with the entity's actual risk management activities. There are 3 main types of hedging relationship. First, fair value hedge. This protects against changes in the fair value of a recognized asset, liability, or qualifying firm commitment. Second, cash flow hedge. This protects against variability in future cash flows attributable to a particular risk. And third, net investment hedge. This hedges the foreign currency exposure of a net investment in a foreign operation. For a hedge to qualify, IFRS 9 requires several conditions. There must be an economic relationship between the hedged item and the hedging instrument. Credit risk must not dominate the changes in value arising from that relationship. And the hedge ratio should reflect the quantities actually used for risk management. For exam purposes, don't try to memorize hedge accounting as random rules. Start by asking, what risk is being hedged? That tells you which type of hedge you are dealing with. There is also an important update for 2026. Narrow scope amendments to IFRS 9 and IFRS 7 were issued by the IASB in May 2024 and are effective for annual periods beginning on or after 1st of January 2026, with early application permitted. One area concerns ESG-linked features. The amendments clarify how certain ESG-linked and similar contingent features are assessed under the SPPI requirements. Another area is electronic settlement. There is a new accounting policy choice that can allow derecognition of certain financial liabilities settled through electronic payment systems before the settlement date, provided specified criteria are met. There are also clarifications relating to non-recourse financial assets and contractually linked instruments, including certain tranched structures. And there are amendments concerning contracts referencing nature-dependent electricity. These are amendments students should be aware of, particularly when studying current IFRS requirements. But don't let these updates distract you from the core IFRS 9 framework. The fundamentals remain: classification, measurement, impairment, derecognition, hedge accounting. IFRS 9 doesn't operate in isolation. The related disclosure requirements are primarily found in IFRS 7, Financial Instruments Disclosures. The objective is to help users understand both the financial instruments themselves and the risks arising from them. Companies disclose information about financial position and performance, including carrying amounts by category and relevant reclassifications and derecognition information. They also disclose the nature and extent of risks. That includes credit risk, liquidity risk, and market risk. For credit risk and expected credit losses, disclosures can include information about the ECL methodology, staging, credit risk grading, movements in loss allowances, and collateral. For instruments measured at fair value, the fair value hierarchy provides information about whether valuations are based on Level 1, Level 2, or Level 3 inputs. And for hedge accounting, disclosures explain the risk management strategy, hedge effectiveness, and the effects on the financial statements. So the simple message is, IFRS 9 tells us how to account. IFRS 7 tells users what they need to know about those instruments and their risks. Before we finish, let's look at 3 mistakes that can cost marks. Mistake number 1. Treating SPPI as a simple label test. SPPI is assessed at the instrument level. You need to look at the contractual cash flows and determine whether they represent solely payments of principal and interest. Mistake number 2. Confusing debt FVOCI with equity FVOCI. This is one of the most important distinctions in the chapter. Debt FVOCI. Recycling to profit or loss on disposal. Equity FVOCI. No recycling to profit or loss on disposal. Mistake number 3. Using the old incurred loss mindset. IFRS 9 uses a forward-looking expected credit loss model. You don't simply wait for a loss event before recognizing credit losses. So if you remember nothing else from this slide, remember SPPI FVOCI debt versus FVOCI equity, expected credit loss. These are areas where students often lose marks. Let's bring the entire chapter together. For financial assets, remember the classification framework, business model plus SPPI. That leads us towards amortized cost, FVOCI or FVTPL. For financial liabilities, the default is generally amortized cost using the effective interest method. Specific circumstances can result in FVTPL. And remember the special treatment of own credit risk for liabilities designated at FVTPL. For impairment, think expected credit losses. Stage 1 gives us 12-month ECL. Stage 2 gives us lifetime ECL after a significant increase in credit risk. Stage 3 is lifetime ECL for credit-impaired assets. For hedge accounting, think fair value hedge, cash flow hedge, net investment hedge. And finally, keep the 2026 amendments in mind when studying the current requirements. If you can follow that structure, IFRS 9 becomes much less intimidating.